9 of the notebook that you would have received at the registration desk is a feedback form. We value your feedback, and we request that you complete this form and hand it in at the registration desk when you exit the venue. At the same time, please collect a copy of the October 2019 Monetary Policy Review. I request your indulgence to allow me to take you through a few procedures in the unlikely event that we have to evacuate this venue. There are 3 primary exits. One on the southeastern side, under the glass dome, clearly marked as Exit A. There is another exit next to the lifts, marked as Exit B, and a further exit on the northern side, down the stairs, past the conference center and syndicate rooms, marked as Exit C. Evacuations will be initiated by a siren or an announcement over the public address system. Please do not panic during an evacuation. Remain calm and follow the guidance of the conference center personnel and the protection office who will guide you to the designated assembly points. Now that we are done with the housekeeping issues, it is my pleasure to extend a warm welcome to our guests and stakeholders who have braved peak hour traffic to join us at this Monetary Policy Forum. The main objective of the Monetary Policy Forum is to enhance the transparency of the policy decision-making process. It also provides a platform for open communication on monetary policy and general economic developments. To commence with this evening's program, it is my pleasure to call upon the host for today's engagement, the Governor of the South African Reserve Bank and the Chairperson of the Monetary Policy Committee, Governor Lesetja Kganyago.
Thank you very much, Dash. My task this evening is an easy one, is to welcome you and apologize on behalf of Deputy Governor Kasim. He is on bank business. I'm going to invite Chris to walk us through the presentation, and then we will take questions. We'll take questions from there. Chris. I normally try to summarize your presentation, but not tonight.
not tonight. Well, thank you for that. Good evening, everyone. I was worried we were going to have a really small crowd. We cut interest rates in July, and then, all interest in what we do disappears, but I'm glad to see that's not the case. Let me start by thanking quite a large team of staff who put this together every time we do it. I'm not going to list names because there are too many, but they can raise their hands. A lot of them are sitting in the front row. So raise your hands. Raise your hands. Raise your hands. They're terrified. Okay, well, never mind. You're welcome to ask them questions during the drinks period afterwards. They do all the hard work on this, I'm happy to say. So let me get into it. The MPR, this time around, we've tried to cast it as I suppose, trying to tell a story about having trying to achieve the mandate in a world of risks. We like to think that the inflation rate has come down in a quite durable and permanent way, but we're not quite ready to say, well, we've achieved that mandate. So the inflation rate has been within the target zone for quite a long time, but as you know, we've started to talk about trying to center it more durably around the midpoint of that target, and I'll talk a little bit about why we're not quite there yet, but pretty close. So what's going on in the environment in which monetary policy operates? Well, clearly you will know there are a lot of global risks out there. The primary ones have to do with the trade war, trade tensions, and the specter of a global recession that has been becoming more evident in the data in recent months in particular, and I'll talk a little bit about that and what that looks like. At the same time, there are a range of domestic risks. Perhaps the most important are shocks that have occurred to the fiscal position, and I'll talk a little bit about how that has an impact on monetary policy. As you know, the domestic growth rate has been low and very volatile, and I'll talk a little bit about sort of how that works in the monetary policy environment. Inflation, fortunately, has been quite contained and remains near the middle of the target range. And as you know, that has created some space for the MPC to move policy a little bit, but there are lots of risks that remain very evident, not just in our analysis, but in our everyday news flow. And these things do matter. So what's the first set of slides are going to talk about the global economy. This is what's happening on the trade tensions side. It's often quite easy to see through the numbers, but I think these numbers tell a particularly worrying story. If you look on the graph on the left, we're showing you world trade, exports broken down by advanced economy and emerging economy exports. So those are the blue and green lines. And you can see, let's see if this thing works here. Yes, there it is. I was requested not to use a pointer, but to use this. You can see that this has really come down quite precipitously from what was a very nice recovery in the world economy from about 2015 up to 2018. And then we've seen these tensions start to feed through, and we've seen quite literally a collapse in world trade growth. That, in turn, is feeding into a much more heightened sense of economic policy uncertainty. On the right-hand graph, I'm showing you what that looks like for the global economy. It's particularly feeding through into China, so that's that purple, here we go, purple line there. You can see policy uncertainty has gone up exceedingly high. In part, the question there is, well, how do the Chinese respond to a weaker economy? We all know that their economy is decelerating, but it's also quite clear that they have less ammunition than they used to try to deal with that. And that, in turn, breeds quite a lot of uncertainty about what they are going to do next and how they respond to that growth weakness. Now, I'm going to struggle with this thing here. You can see for the U.S. as well, that green line, a quite persistent upward slope in that line, saying more or less the same thing, but somewhat less aggressively than in China. So what's getting hit? Well, of course, that's manufacturing. And you can see that on the left-hand graph where I'm showing you industrial production in the U.S. is red, Euro area is blue, and Japan is green. And so large economies that are primarily export dependent, like Japan and the Euro area, are seeing a much stronger hit to their industrial production than, say, the US. The US is getting affected by it, and it's much larger, or is a very large component of the world economy, so it matters, but it's not quite as severe as you can see from those countries that export more. It's translating into GDP growth, again, more aggressively in countries that are more dependent on exports. What we're showing you on the right-hand graph are South Korea in the blue, here, and then here you've got Japan. So these are the decline in their growth rate over the period March 2017 to 2019 June. You can see that's come down by over a percentage point for South Korea. For Japan, it's quite a big drop. Germany, it's quite a major drop, and you can see that's almost 4 percentage points of GDP growth. The US, again, a little bit more balanced, bigger economy, less dependent on exports, but still getting affected by that. So what's keeping those growth rates afloat at all? Well, part of it's services. And I'm showing you a global PMI broken down into manufacturing and services on the left-hand side. And that green line is above 50, so it is still expanding, whereas your manufacturing is now in contractionary territory here. Those services and other economic activities that are less dependent on exports are keeping these economies afloat and continue to generate some reductions in the unemployment rate. But if you look quite carefully at these, you can see these things starting to flatten out. That's probably normal in any event, but it won't be helped by further weaknesses in exports. And obviously, job creation is a prime support to domestic consumption generally, and you can see it in these economies and the difference to manufacturing. At the same time, output remains for many of these economies near potential. Now I'm getting into a bit of a policy discussion. So what do economies do when their exports are falling for the reasons we've outlined? Well, this is G3 GDP growth, which is purchasing power parity weighted. You can see that that's remaining still relatively good. On the right-hand side, you've got your G3, Japan, United States, and Euro area output gaps. And you can see how these have closed in this post-global financial crisis quite well. Japan is well above its potential growth rate. The US has just achieved it last year, and the Euro area is very, very close. So it's not entirely clear that overall that there is a large aggregate demand shortfall facing these economies. At the same time, inflation remains persistently below targets. The one exception here is the UK, which is the red. And you can see what's going on there is that with Brexit and other drivers of the exchange rate, their exchange rate has depreciated quite a lot, and that has fed through into a higher inflation rate for the UK. Other economies, the inflation rate, again, as you will be quite familiar with the story, approached their inflation targets up to 2018, in the middle of 2018, and then started to decelerate again down through 2019. And that's generated quite a lot of change in policy expectation. That's what I'm showing you here. The blue on the left-hand side is the two-year government bond yield, and we've kind of put this against an event outline of what's happened over time. And you can see how that two-year government bond yield increased starting in December 2015 with the Fed starting to tighten policy. You had the second rate hike kicking in about here. Then you had balance sheet normalization policies, so the unwinding of QE, or not quite unwinding, the slowdown in QE was talked about by the Fed. And so you started to get this expectation that there was a robust U.S. recovery and that the inflation forecasts of the Federal Reserve were going to materialize, and so your two-year bond yield starts to rise. And that all abruptly changes again, as you know, in December of 2018, where the Fed hikes for the last time, and then we start this kind of reduction in inflation and this growing expectation that the Fed is going to reverse course and start to cut rates. And you can see what that looks like on that two-year bond yield, coming down quite sharply from almost 3.5% down to something around 2% now. Germany, the same sort of thing. Of course, we're talking about the ECB here, but you see the same kind of decline in bond yields over time. Now we're in negative territory, so we're talking about German two-year government bonds. And then the ECB starts to reflect that it might unwind policy, so the easing policy will reverse, and you get that bond yield coming back up. Then you get this fresh stimulus by July 2019 and a reversal in expectations of future inflation, and of course into bond yields. You get this very sharp drop again. So it's strange times in financial markets for sure. This graph on the left shows you that this carries beyond the two-year bond spread. So what I'm showing you on the left is the 10-year bond yield for the U.S. government bonds minus the two-year yields. And normally there should be quite a large gap or spread between them, as you can see over this whole period here. But that really collapses in particular from 2018 onwards. And that contributes to this phenomena of negative yields across a very large and growing volume of advanced economy bonds. And I'm showing you what that looks like on the right-hand side. So this is the measured in trillions of US dollars, the universe of negative yielding bonds that are out there. And you can see these were very steady from about 2016 to 2019, then have really accelerated very strongly as more and more advanced economies issue bonds with negative yields. Now, why does that matter for us? Well, it matters quite a lot, as it turns out. Because when that kind of thing happens, and has happened in the past, we've seen waves of capital flowing into emerging markets, taking advantage of the positive yields in countries like South Africa and others, and generating an inflow of capital and stronger growth. But we're not seeing that. So risk aversion, in a sense, is getting in the way of this search for yield. We've talked about, how do you distinguish between being in a risk-on and a risk-off environment? So those negative yields suggest we should be in risk-on, but it's not quite happening, and so the reason we want to understand why. Gold price on the left is a really nice measure of risk aversion, and you can see that that's reached a recent high again. And then on the right-hand side, we're looking at equities performance. So one of the things that we should see is capital flowing not just into portfolio assets of emerging markets like bonds, but also into equity markets. And again, that really has not happened. The blue line is the developed markets MSCI measure, and then the red is the emerging markets. And what you can see happening here is a divergence where capital that needs to go into equities remains in those equity markets rather than going into emerging markets where you would expect, or you should expect, stronger growth. So again, it's the same point. EM growth is slumping against advanced economy growth, and that's why that equity flow isn't coming in. This is just showing you a differential between emerging markets and advanced economies. That differential for many years was very strong. So this is the difference between the growth rates of emerging markets and the growth rates of advanced economies. When China's not included here, it would be even bigger, of course, if China were in here. But you can see how this has really come down very, very strongly. There has been really over the global financial crisis, post-global financial crisis period, growth was pretty good in this sort of 2009 to 2013 period. Countries like Brazil grew very rapidly in this period, but then things started to fall apart from about 2013 on with the taper tantrum, and so we started to see emerging markets growth rates slow. So part of the problem we'll hypothesize is that the strong dollar is part of the issue here. Back in that period of 2009 to 2012, 2013, when Brazil was growing very rapidly, there were a lot of emerging markets complaining about the fact that there was this currency war going on and capital was flowing into emerging markets, and this was appreciating their currencies and leading to weaker growth outcomes. We're not quite sure about that. We're going to take a slightly different view of this, which is that a strong dollar tends to be associated with weaker emerging market outcomes. What I'm showing you on the left is the real broad dollar index over time, going back to 2000, very strong in that early period of this period running up to 2009, was weakening over this period, but it's still pretty strong, and then flattens out from the global financial crisis, and then from about 2013, 2014 on, the dollar starts to strengthen again. When we superimpose that in an inverse way on the right-hand graph against capital flows, net capital flows to emerging markets, you can see this relationship quite well. So when the rand strengthens here, dollar strengthens here, I have to get my currencies right. The dollar strengthening in this jump down here, you can see how net capital flows to emerging markets fail. And then you can see how here, where the dollar starts to depreciate, you get a bit more of a capital flow pickup to emerging markets. So there's a relationship with the dollar that is quite different from the way we used to think about it a few years ago, or some of us used to think about it, and it remains a concern. Other parts of this emerging market weak growth story have to do with general government debt. You can see on the left-hand graph, we're showing you emerging market general government debt as a percentage of GDP, which has picked up quite strongly in this post-global financial crisis period. Debt played a big role in the strengthening of growth rates for a while, but then starts to pick up a momentum of its own. On the right-hand graph, I'm showing you emerging markets total credit to non-financial private sector. For emerging markets, that's in blue, and then emerging markets minus China, which is in green. And you can see that non-financial private sectors were part of this, this very rapid escalation in debt. The difficulty is there's not much to show for all this. Investment growth, as you can see on the left-hand graph, has really plummeted. So despite the debt levels rising particularly rapidly over this period, you're getting a much weaker investment growth rate than we'd had before. And we're also seeing a lot weaker total factor productivity growth, and I'm showing you that on the right-hand side. So those gray bars are total factor productivity growth pre-crisis on average for a range of countries running from Russia, China, Thailand, India, the Philippines, South Africa right in the middle, Indonesia, Argentina, Turkey, Mexico, and Brazil. So we're showing you pre-crisis, and then post-crisis is those red dots. And there are a few countries there like Thailand, Indonesia, Philippines, China to some extent, which have maintained a fairly brisk rate of growth in total factor productivity. But there are a range of emerging markets, in particular here on the right, running from South Africa over, where that total factor productivity growth has been quite weak. And there are various kinds of reasons for why that's happened, but certainly if you're running up a large debt stock, you want to see a rapid growth in investment, and that should translate into good productivity growth. So as you would have seen from that last graph, South Africa is in company with a range of emerging markets. We have the same kinds of issues here. There's a lot more debt, but there's quite a lot less investment and weakening productivity. And so I'm just showing you that government debt level. If I showed you total debt, you would see a similar kind of story. And then on the right, you can see investment growth rates for South Africa in red compared to emerging markets and emerging markets excluding China. We're doing a little bit worse, particularly since after 2016, but we're roughly in the same kind of league. That debt has been driven up by the gap that I'm showing you here between higher taxes and higher spending. So government's global response to the global financial crisis has been to maintain a robust level of spending, and they've tried to raise revenue to match that spending. But that gap between those two lines, of course, is the deficit, the fiscal deficit, and that's been large and growing over time. It's been large for some time and then has started to grow again very recently, and that's adding to your debt level. So the risk that we're pointing out here is just around the problem of renewed fiscal slippage. So the fiscal deficit is what I'm showing here. The budget balance, main budget balance, is percentage of GDP. And you can see this is your bit where you responded to the global financial crisis by keeping growth low. And then government moved that budget balance a bit lower, and as growth started to weaken, that tax revenue started to go up. But they had achieved a smaller budget balance, so they were moving in the right kind of direction. And then they've been hit by a series of negative shocks to the fiscus, not least coming from the ESCOM bailout, and that's generated an expectation, which I'm showing you in those three right-hand columns, of a deterioration in the fiscal position. So why does that matter for us? Well, it creates a risk in the sense that it's countering some of what's happened with inflation coming down lower. And one way of understanding this is seeing it is via the yield curve. And that yield curve on the left-hand side, so this is 2-year running out to 30-year yields, from September 2018 to September 2019 is actually steepened quite a bit. In the short end, so this is right here, what we've seen is that interest rates have come down with a decline in inflation. But that's made the steepening of the yield curve worse. If you look on the right-hand side, you can see the same kind of point, just expressed slightly differently. You can see how 10-year government bond yields keep creeping up, again, despite the fact that inflation is a bit lower. So as the inflation risk premium starts to compress, something else is filling that gap, and that something else is a bit problematic. The risk carries on a bit further into our external balances. So one of the things that's driven our current account deficit is these interest payments that are derived from that high level of debt to non-residents. So non-resident investors are a large proportion, roughly 40% at the moment, holders of South African government bonds, and we pay payments out to them, and that is a current account item. And I'm going to show you what that looks like just now on the right-hand side. So our current account is bigger than we would like it to be. If you look comparatively speaking on the left-hand side, you can see we are quite far over to the left. There are a range of emerging markets here which have significantly lower current account deficits, and obviously a number of countries, many of them very strong exporters, but also high saving economies that have positive current account balances. So part of what we've seen over the last couple of years is with weak growth, our imports have fallen. And so we've had a bit of an import compression, which has turned around that trade balance, which is what I'm showing you on the right-hand graph, the green, from a deficit in this period into a surplus by and large since roughly 2015. So we've had running a trade surplus, but our current account deficit, which is this gray bit here on the left-hand side, remains in this fairly significant deficit level, and that's because of these income payments that come through on the current account on the income payments line. So that current account deficit remains a concern. Now, what we should have seen over time is that import compression helps to close that current account balance. And it should have happened also alongside a weakening in this output gap. So we've inverted the output gap. That's the blue line here. Oops. I'm going totally the wrong direction on this thing. There we go. As that output gap became more negative, that current account balance should have squeezed up towards zero, that red line. But we didn't see that. So the current account on its own has become less responsive to the weak growth that we're having in the economy. As the economy slows down, that current account deficit should have shrunk considerably more and taking risk out of the way in which the economy is seen. So now I'm going to move a bit more directly into monetary policy. That weak growth rate that you all be familiar with, that output gap Q1 surprise, pushed that output gap more negative. That's what I'm showing you here on this graph. You can see this decline right here. That's Q1, and then the Q2 reversal bounces that back up there. But one of the difficulties of understanding sort of how you deal with this output gap is that a lot of the growth data that we're getting is quite volatile. And with that output gap jumping around, the point is that there's a kind of trend in the data that it's very difficult to actually see. We're showing you on the left-hand side just the quarter-on-quarter seasonally adjusted annualized rates of GDP growth. And you can see if we went further back in time, which is what I'm showing you on the right-hand side, I'll get to that just now, but you can see that these numbers are really very, very volatile indeed. Of course, from a policy point of view, you don't want to make a mistake and react to this number if suddenly this is the next number coming up. The point really is that you want to be able to see through this volatility, but it's very difficult to do. And it's very difficult to do when that volatility is increasing. So the graph on the right shows you the standard deviation of GDP growth rates going back to 2000. And so you can see from this period, 2000 to roughly the global financial crisis, your standard deviation was substantial, roughly 1.5%, but it wasn't, it was manageable and it was relatively stable. The global financial crisis, unexpected major change in GDP, you get this outcome. And then this is the post-global financial crisis experience running from 2009 to 2019. And you can see how that, again, that GDP volatility is picking up quite a lot. So what explains that? Well, part of the explanation is that near-term potential growth is quite low. This is our measure of potential growth in which we adjust for supply shocks. And I'm just showing you, just for example, you get quite a big jump down in potential growth in this period, 2013 into 2014. There was a big platinum mining strike and load shedding occurring. Here you had the drought in 2016 and running into 2017. That pushed potential growth quite low. And then again, there was some more load shedding more recently. Those shocks to growth have a big impact on the actual growth. So that's the gray, if you can see that. Yes, you can. You can see how that drought collapsed the agricultural sector and pushed down the total economy's GDP growth rate quite aggressively. And here you can see the bounce back of that. But our potential growth rate, which is how we measure the output gap, you can see is bouncing around a lot. And again, more volatility complicates the way in which you use those potential growth numbers. It seems more clear, I suppose, that demand and confidence factors are both important in explaining weak growth. The right-hand graph shows you business confidence. You'll be familiar with these numbers coming out quite low. When you unpack those on the left-hand graph, these are constraints in the manufacturing sector. You can see a variety of things going on. Interest rates are that blue line. There are times, particularly in 2008, where interest rates were seen to be a very strong constraint on the manufacturing sector, but that has fallen post-global financial crisis to pretty low levels and picked up a little bit more recently. The political climate has played a very strong role in perceptions of constraints to the manufacturing sector, and insufficient demand also is in the red. So there's a reticence to spend. Foreign demand seems to be a bit weaker, and that's generating a fairly high level of concern about demand generally. When we look at growth from a nominal GDP point of view, there's a range of things going on. So I'll come to how this impacts on inflation just now. But one of the comments that we've heard a lot about is, well, nominal GDP is much lower. And that should play a stronger role in how we think about policy. Yes, it's true generally, and I'll come to why. But when you unpack just the basics of the nominal GDP, what you can see is that the biggest pull down of this blue line, this is on the left-hand side, I'm showing you nominal GDP growth rates year on year from 2002 up to 2019. And you can see how this has come down quite strongly. A big chunk of that pull down in nominal GDP is coming from real GDP, which is taking out about 3.2 percentage points out of that nominal growth rate. So in that period from 2001 up to 2010, 2009, your real GDP growth rate was about 4.2%. Since the global financial crisis, it's come out at about 1%. You can see that there. If you look at, I'll jump to CPI now, that's on the left-hand side. So this is just the CPI, headline CPI over a very long period of time. And you can see while on average we've gotten that CPI down a bit from 5.2 to something like 4.8, so there's a bit of a nice progression, it has been roughly, kind of more stable than some of these other numbers. And so we're not convinced that the nominal GDP slowdown that you're seeing on the left-hand side is fully explained by the CPI number. The GDP deflator is an interesting one. A GDP deflator is a broader measure of CPI or of inflation. And what we think is going on there is there's quite a lot of terms of trade effects. So slowdown in the world economy has taken some steam out of our export prices, and that's translated into quite a large reduction in that GDP deflator from about 7.7% on average in this period here to something like 4.4%. CPI, as I just noted, has remained close to the midpoint of the target roughly since 2017. You can see that period here. Yeah, right there. And we've had some outcomes more recently that are below 4.5%. But what the MPC has tried to point out is that much of this near-term reaching inflation rates below the target has actually been due to temporary factors. So you can see on the left-hand side how that inflation rate has come out, 4.2, 4.4, 4.1, 4.3, just below that 4.5%. But our forecast shows it jumping up again. And this is one of these situations where there are some exogenous factors driving that headline number. On the right-hand side, I'm showing you the breakdown of how this works. So food in particular has taken quite a lot of steam out of headline inflation running up to the current period. Fuel has taken quite a bit out, in particular very recently. Core inflation also has trended a bit lower, and this is driven primarily by the exchange rate and goods prices. I'll show you that just now. And then in our forecast going forward, we see some of these reversing, and so we see a pickup in food. That's that yellow bits there, and the red is the fuel, and then we also see core inflation coming back in a little bit. So these are sort of short-term drivers of inflation. As I noted, core inflation has remained quite subdued, and a large chunk of the explanation for that is the exchange rate has helped to drive that. You can see there's a very strong correlation between core goods inflation, which is that green, and the rand-dollar exchange rate, which is the blue. So there's almost a one-for-one correlation there, and depreciation of the currency obviously will play a large role in your core inflation outcome. Okay. From a slightly longer-term perspective, and certainly quite positive from a policy point of view, is that we've seen surveyed inflation expectations over 1 year, 2 year, and 5 year horizons coming down quite nicely, and that's what I'm showing you on the left-hand side. These are averages of labor, business, and analyst expectations. Again, if you think back to a year or two ago, you will reflect on some dire sort of commentary that we had about this, that we kept saying we would like to see these inflation expectations come down well below that 6% level, which is here. And indeed, they started to do that, and in fact have accelerated a little bit in this sort of late 2017 through 2018 period. And they look like they might be stabilizing a little bit. But this is a key indicator of future expectations of inflation, and obviously play a key role in telling us something about policy. The market has gone in a similar kind of direction with inflation expectations calculated with the 5-year break-even and the 10-year break-even also coming down. You can see that 10-year is not quite as convinced as the 5-year, so over a longer time horizon, inflation expectations haven't quite come down to the extent we'd like. So there are two things here. There's a trend, which we're obviously very happy with, and there's a level which could improve a little bit, certainly. One of the key drivers of our inflation forecast, and really of any model of inflation for any economy, will be the role of nominal wage growth in unit labor costs. We show this graph every time, and it features quite a bit in our material that we talk about, the MPC. Again, there are some very positive developments here. Nominal wage growth in particular since 2017, I'm showing you that here, has decelerated quite nicely from something around 6% to something closer to 4%, and that has helped to close something we call the unit labor cost gap, which is just the contribution to inflation in our QPM model that is derived from the excess of real wage growth over productivity. And you can see that that has come down quite neatly with this decline in nominal wage growth and carries through. Stronger productivity growth would pull that unit labor cost gap down even faster. So as the economy's weakened, that unit labor cost gap has been held up a little bit more than one would like. That's that yellow productivity bars here. Services are also indexing to lower CPI outcomes. I'm showing you that on the left-hand side. So we like to think that inflation expectations have a lot to do with services inflation. And you can see a very close correlation on the left-hand side for that. And we expect that to continue to moderate down towards that midpoint of the inflation target. Housing has played quite a large role in this. So on the right-hand graph, I'm showing you services and services excluding housing. So services are helping to pull down these things. Housing has come down in particular right at the end in 2019. This is through the owner's equivalent rent number. And there are a couple of different things going on in the housing market. One is that supply has increased a lot. So residential buildings completed is what we're showing you on the left-hand side. It's a very volatile number, so we have a 12-month moving average of that in billions of rand, and you can see that the construction boom that we've seen for quite a number of years now has kind of paid off in the sense that the housing stock has increased a lot, and in particular over the past year or so. And at the same time, demand for housing has weakened. So the graph on the right shows you from FMB the surveyed reasons for wanting to sell your house, and then that includes everything from downscaling due to financial pressure, upgrading has come down a little bit, and emigration has also picked up quite a bit in recent years. So both supply and demand factors are pulling down on that housing inflation number. So I'm nearing the end. Where do we stand relative to peers? This graph is a little bit confusing. What I'm showing you on the left-hand side, so that vertical axis is the proportion of countries, and on the horizontal axis I'm showing you the CPI inflation rate. So if we just look at the blue line for advanced economies, you can see that almost all of them, 60%, fall at an inflation rate of about 1.1 to 2%, and that's right here. And then as a smaller proportion have higher inflation rates, these will be some of the smaller OECD countries in particular. The red line shows you emerging economies, and you can see here that a large proportion of them, well over 20%, sit at an inflation rate just around 3.1 to 4%, and the vast bulk of them are actually from that inflation rate to the left, and so have quite low inflation rates indeed. So all of the countries that fall into this basket here have inflation rates that are quite similar to advanced economies. South Africa's here, so we remain a little bit on the right-hand side of this distribution, a higher inflation rate than quite a lot of countries, but certainly well-contained inflation relative to all of these others that are sitting out here on the right-hand side, close to 10% inflation rates. One of our concerns, not just from a comparative perspective about inflation, is the role of public sector pricing in inflation. So this is one of the things that's featured in MPC discussions in recent times. We've created our own government CPI number, which is that red line over time. It includes a whole bunch of things that we've thrown in there, not just administered prices, but also things that are impacted a lot by changes in taxes and non-alcoholic beverages, soft drinks, alcoholic beverages, and various other things down in that footnote there. And you can see that there have been periods where that government CPI number has been well above the target, in particular in this period, and then again more recently. So even though we've had quite a lot of disinflation of our headline number excluding that government CPI, so that's the blue, the gray is the headline, you can see that this is pulling it down. These things have been pulling it up. They are quite volatile, but obviously they play some role in keeping headline a little bit more elevated than we might expect it to be. Lower inflation has provided some policy space. I'm just showing you on the left-hand side, the prime lending rate and the repo rate, and you can see As the economy has weakened and inflation has come out quite a bit lower, that has enabled us to adjust interest rates on the margin. What the QPM tells us about the repo path is on the right-hand side. And you can see here that if you go back to March 2019, that repo path was telling us that we should be raising rates quite a lot. So the world was quite a different place at that time. Various things going on, not least that the U.S. recovery was expected to continue and the U.S. interest rates might continue to rise. There were also concerns about a much more depreciated exchange rate. But as those risk factors came away, the repo path generated by the QPM has fallen quite substantially. So by May already we were at this yellow path. July is that green path, and September is the blue. So from May onwards, we've kind of been in the same sort of rough area of what the model is telling us the repo path ought to look like. From a longer-term perspective, the real repo rate is back to sort of mostly around its neutral level. You can see the left-hand graph, we show you the neutral rate, which is that gray line, not very volatile, moving along here. You can see this is the post-global financial crisis period where all of the indicators were pulling down on that neutral real rate. And then from 2013, roughly, things start to change. So roughly about here, you start to see the neutral rate creep back up again. And the real repo rate does as well, in particular as inflation starts to move down from the 6% level to something closer to 5 and then on to 4. There are different ways of deflating these numbers. You can kind of think about this in ex ante and ex post sort of terms. If you deflate the repo rate by the blue, the BER 2-year ahead inflation expectations, you get a real repo rate that looks like this light blue line here. And relative to neutral, it is firmly in expansionary territory. If you use a more coincident inflation rate, so when the inflation rate falls on a month-on-month basis, you get a jump up in that real repo rate. And that's kind of what you're seeing here with that black line. But there are different ways of thinking about policy and how it works. We tend not to use these numbers too literally. They're guideposts for about where we are relative to that neutral real line, rather than picking a particular point and saying, okay, the next policy adjustment has to be as follows. That's not really the way it works. The evolution of the real repo gap. So this gap that we're here in the gray bit, we're blowing up on the right-hand side here. And you can see as the inflation rate picks up again and the repo path stays where it is relative to a rising neutral rate, the policy becomes quite a lot more accommodative for the next couple of years. Risk feeds a lot into neutral. And it is a constraint on policy. So I'll come back to this point just before I conclude. That blue line on the right-hand side is your equilibrium risk neutral. And the red is the South African specific risk rate. And that's driven by a variety of things, but we use an MBI for South Africa to get that number, to tell us something about that number. And you can see how in 2019 this has really jumped up quite strongly. On the left-hand side, we're showing you a comparative view. So there are a range of emerging market economies with considerably lower EMBI spreads of their own. And there are a few, Argentina, Ukraine, Turkey in particular, that have much higher risk profiles. South Africa is in the group of the lower risk, but we're kind of on the margin, and obviously that is a bit of a concern. And that translates into that right-hand graph of creating a gap between the perception of risk of the economy and the neutral real rate, and that it is pulling up that neutral real rate over time. So let me conclude. Two big risks in the environment, trade and fiscal issues. Low growth remains a big problem. In the short run, growth is certainly quite constrained. In the long run, it's obviously much more dependent on investment. Some of you will have seen previous versions of this presentation where we unpack those investment growth rates. I haven't done it today, but obviously a much stronger investment growth rate would have a lot to say about future growth. Actual growth remains low, again, as you've seen, and so our output gap on balance remains quite negative, and that feeds into policy. And policy, a stronger communications message, some tweaks to interest rates from time to time, but they're pretty marginal, are helping to steer inflation lower to some extent. Certainly they seem to be having a pretty good impact on expectations, and that's quite a positive, and we're getting close to a more sustainable position around the midpoint of that range. I guess the punchline for me here is that lower inflation plus a lowering of some of the risks that I talked about would create more of that policy space, but the MPC hasn't quite found its way to be comfortable about how much space there is yet. Thanks. You want to leave it?
Thank you very much, Chris. It's that time of the day where you could ask questions. Please identify yourself and the institution you are coming from. It's been thoroughly confusing. Yes, ma'am.
Hi, it's Mama Keto from APSA CIB. I've got two questions. So the one relates to monetary policy as related to actual cost of borrowing. So I think we've been speaking for a while, and there's a rough consensus that regulatory changes in the banking system have made actual borrowing conditions or borrowing rates higher than what is implied by the repo rate. Has the SARB thought about using tools other than monetary policy or other than the repo rate to adjust the environment to this? So, for example, if you could use the same tools as you would that you have in your macroprudential toolkit, only in reverse. Then the other question relates to the falling demand, global demand, and the trade war. So what part of that relates to the trade war, and which part of that is in any case a natural slowdown that was going to occur anyway due to falling Chinese demand because of rebalancing and the changing of the rules or the regulating their financial markets?
I didn't quite get the last bit of change in regulation of the financial market. Are you talking about global changes in the regulation?
No, I'm talking about our market. So I think there's a rough consensus that we have that the change in banking regulation has led to rates or policy or lending rates being tightened by much, much more than what you see when you look at the repo rate. And that's one of those discussions that's been ongoing to say...
Yeah, I got that. That was the first part of your question.
The second question
the second part of the question, you're talking about trade wars and global demand.
Oh, is that the one you didn't get?
And then suddenly you put in financial market regulation.
In China.
Financial market regulation in China.
Yes.
Okay, I'll find one. I'll get one of the Chinese on the panel here to respond. Yes, ma'am.
Elise Kruger of NKC. Governor, it seems clear that the MPC is stuck into a risk management mode at the moment. I wondered whether you could maybe describe a scenario where, in terms of talking about the risk, that you would be comfortable that that part has sufficiently improved to create that needed space for further monetary policy loosening. Thanks.
Any other? 1, 2. Can you switch that microphone off? Thank you, sir. Rob.
Thank you, Dr. Jeffrey, econometrics. I think it's common cause. We're all aware that low growth in the future, or growth in the future, is very much dependent on the actual confidence in the economy and the amount of investment flows that come into the country. But has the Reserve Bank ever worked from the basis that confidence is also affected by the amount, or is measured in a way by the immigration that takes place, and it's affected in a number of areas that were mentioned here? What is the cost in terms of GDP of immigration to this country? Because it's also a measure of the confidence and what is an impact, what is impacting the economy.
Thank you, Bob.
Isaiah from Alexander Forbes. I just wanted to get a sense of what is the proportion of domestic risks relative to global risks in the risk premium?
Okay, last one in this round. Okay, there isn't. Are there people in the... Okay, good. Mamagate, the stuff about regulatory changes and monetary policy and macroprudential, it's important that we not conflate issues. The issue of the global regulatory reform that had taken place has not had as much an impact in South Africa as it had in the advanced economies. Why are we saying that? It's because in South Africa, getting into the global financial crisis, our regulatory stance was far more stringent than what you had seen in other countries. Put simply, we had a well-capitalized financial system. It was well supervised, and it had ample liquidity. By contrast, in the advanced economies, institutions were thinly capitalized, and so when the crisis hit, governments found themselves having to inject capital into their financial system. At the time of the global financial crisis, South Africa was already on Basel 2.5. I can say to you that many advanced economies were still lagging behind. And actually, what we had seen was that when the new standard for capital was set, South Africa didn't have much to do in terms of increasing the capital adequacy of the of the banking sector in particular, because South African banks had buffers relative to the capital. So when the capital standard of Basel III was introduced, South African banks had a lot of headroom, at least in as far as capital was concerned. The impact on the sector came via the liquidity standards. The liquidity coverage ratio, in the case of South Africa, the banks could almost not meet it. And the reason the banks could not meet the liquidity coverage ratio had nothing to do with how the banks in South Africa were run. It had to do with the fact that, like other countries such as Australia and New Zealand and so forth, we had run prudent fiscal policies. And the way in which the liquidity coverage ratio works is that the banks must hold high quality liquid assets. And those high quality liquid assets were defined as government issued paper. And so there wasn't a lot of government-issued paper doing the rounds because the debt in South Africa was well contained. And so we ended up having to put a contingency line to augment the liquidity coverage ratio, and that was provided for by Basel III. The net stable funding ratio was the second pillar of the liquidity standards. And there it was a little bit tricky because it was trying to get the banks to match their assets and their liabilities. In other words, constrain the maturity transformation role that the banks have. Well, problem is banks lend out mortgages to 20 years, 25 years, but deposits are short. And globally then, what you then had was that there was a move then to try and push the banks to attract more long-term deposits and more retail-based deposits, because, you know, the retail depositors, they are the last ones to exit once all the smart money has left. So they are seen as the more reliable depositors. So when Basel III was introduced in South Africa, we had to do an impact assessment, and this impact assessment was done consistent with what we had seen elsewhere. The BIS did a global impact assessment of the implementation of this regulatory standard. In South Africa, we also did that. One thing that is clear, and it's interesting how the banks has responded. Let's get things clear here. What we experienced before the global financial crisis is not normal. So a return to normality does not mean a return to what we had seen before the global financial crisis. So the kinds of returns and profits that the banks were showing prior to the global financial crisis, even as what we call normality returns, bear in mind it will not be what you saw before the global financial crisis. The banking landscape will change. Business models has to change. And let's get things clear. As the banks react to the introduction of these new regulations, business models change, banks have to adapt, and actually, in many instances, global banks have pulled out of certain product lines, and some have even pulled out of certain markets. That is the landscape that we have. Those regulations were dealing with the safety and soundness of the financial sector and the resilience thereof. And actually what you commonly refer to as Basel III, in global terms we called building a resilient financial sector. Those instruments are used for one thing. The repo rate and monetary policy are used as tools to deal with inflation. So we must not confuse them. You cannot use monetary policy to try and deal with the safety and soundness of your banking sector. In the run-up to the global financial crisis, the view among central banks was that if we had price stability, then everything will fall into place. And as we had seen in the developed world, not enough attention was paid on the state of the financial sector, and that is where the source of the crisis actually came from. Enter the macro-prudential tools. And these had been proposed, and they vary. And the way in which these things are is that they are actually asymmetric in nature. So you can impose loan-to-value ratios when you have got a property boom. it doesn't follow that when you reduce, you adjust them in the other direction and say that, okay, you can have a loan-to-value ratio of 100 or 110% like we had seen in South Africa prior to the crisis. It doesn't follow that you will set a boom. So, different tool sets to deal with different things. Macroprudential tools to deal with the financial cycle. What is beginning to emerge now is that how do you try and think about the use of all these three sets of tools in an integrated manner? That proves to be much more complex than when you deal with these instruments to target particular problems. Put simply, Mamuketi, you cannot use the repo rate to deal with the problems in the banking sector, and neither should you try to use the tools to deal with the safety and soundness of the banking sector and hope that you could use that to deal with your inflation problem. Trade wars and the global demand, sure. After the recovery, you had or rather, let me take it back this way and say, as we were responding as a global community to this global slowdown in 2008, 2009, one of the things that emerged was that we have got to get global trade going again. And we spent a lot of effort trying to get trade going again. What had made the Great Depression really great was that measures were taken that actually impacted negatively on global trade. And so the response was that we should get trade growing. And this, in the main, coming out of the G20 London summit. And we saw the global economy recovering. Yes, there might have been a slowdown, some slowdown, but the global trade war made it worse. There cannot be winners in a trade war. The global economy can only be the loser from that trade war. One of these days, I guess I will get the staff of the Reserve Bank to try and decouple this thing. What proportion was the result of the trade wars and what proportion would be a result of, in any case, global demand was slowing down, and I will get them to publish a peer-reviewed article because I think that if they succeed in it, one of them might just win a Nobel Prize. Josh, the MPC stuck in risk. The MPC is not stuck in anything. We are not stuck in anything. We are as dynamic as we had always been. It struck me about one thing. Somebody asked the question, where are the doves? And I asked, where are the hawks? And I looked back. People were asking, there was consensus about keeping rates the same. These chaps are risk averse. But in July, we cut rates. We were not called risk averse. And the decision in July, just like in September, was a unanimous decision. And if you look back, 18 meetings, these 2 meetings are the first time that we had unanimous decisions in a long time. We are not stuck in anything. The discussions in the MPC are robust, and it's exactly what one would like to see. There is a diversity of views in the MPC. There are people who might arrive in the MPC holding different views, and when they leave the MPC, they leave with views different from the ones they came with, And that is because of the nature of the collegiality, that we debate things and we move positions based on what your colleagues are actually saying. We're not stuck in a risk management mode, but we must continuously be aware of the risks and manage the risks. We do take cognizance of the risks that we think are likely to materialize, and the ones that we are not sure whether they would materialize, we communicate that. The stance that we have taken has not taken cognizance of the following risks, and we will spell the direction of the risks, whether the risks will impact inflation on the upside or on the downside. We will spell out whether the risk will impact growth on the upside or on the downside. There is no need to be stuck in anything. We are a very dynamic team. Which brings me to Isaiah's thing about whether we have done any work about the proportion of the risks, whether what proportion is domestic and what proportion is international. We do not weight these things. We will spell out there are the following international risks and there are the following domestic risks. We cannot quite attach the probabilities to these risks, or maybe we could, but we have not done that work. Rob, well, Dito, we have not done work on immigration, but let's just think a priori what immigration does. Firstly, it erodes your potential because the people likely to emigrate are your skilled people. That's one. And two, because it is skilled people, they are likely to be high-income earners. That erodes your tax base. But because they are also high-spend earners, that means you are taking out significant consumption out of the economy. How much I wish we were in 2005 again and there was the homecoming revolution. But I'm not on Facebook, but I heard yesterday that what was trending on Facebook was "I am staying," and may I wish that you stay so that we can actually build this country together. The former Secretary of the US Treasury has a saying that says that restoring confidence is the cheapest form of stimulus because you do not have to spend much on it. And if you saw one of the graphs that you had there about the concerns of the manufacturing sector, you would see that the concerns about the political situation had spiked and is higher than at the time of our transition to democracy. And that is actually a worrying thing. And I've got no doubt that we can work together to restore that confidence. But to restore the confidence, you can't just make pronouncements. What you said you are going to implement, you have got to implement and be seen to implement it with vigor and demonstrating progress. That is what would restore confidence. That deals with this round of questions. Have I missed anything, my fellow panelists? Because this is the last bunch of questions I'm answering. Everything now, from now on, is yours.
I just wanted to say that on the trade and China growth issue, I mean, I think, first of all, you need to look at the numbers. So it's the change in export volumes relative to GDP. And obviously, if they continue to fall the way they've been falling over the past 6 months, then it's going to start to translate into sharper GDP reductions in places like China. For sure. But I think what I find quite worrying about it is that it's upending a large chunk of the global value chains that drove productivity growth for a large part of the last 20 years. And, I think that's what is very disconcerting for businesses, and they start to disinvest or try to figure out what kind of investment pattern across which kinds of countries aren't affected by the tariffs. So, and the point is just simply that, sitting and looking at it today doesn't give you a very good sense of how bad the growth outcomes could be sometime in the future. I mean, they're kind of unknowable, right, because there's so many moving parts at the moment. But what we've seen is pretty bad as it is. And as that translates into investment decisions, it's going to get worse and worse and worse.
Chair, just a small addition on the immigration issue. We haven't done any work, and I think it's always good to try and have an informed, evidence-based discussion. There's an interesting article on the Daily Maverick website today entitled, "Are skilled white South Africans really emigrating at an accelerating rate?" I'd like to refer people to that article for some of the facts.
He is very stingy with his facts. He could have shared them with us. Any other questions? Yanni. And there's another hand at the back. And then Azar. And one in the middle. And that's. I will come to that. Can I take these five? 1, 2, 3, 4, 5.
Thank you, Governor. I'm Yanni Rousseau from the University of the Witwatersrand. I would like to know what the Reserve Bank's view is on the economic recovery growth plan recently published by the Minister of Finance and the National Treasury. Thank you.
Yes, sir, at the back.
Hi, I'm Michael from Aritz Power Solution. More in the energy sector, but I'm quite interested to ask two questions. One is when Chris spoke
Can you
about...
speak closer to the mic?
Yeah. One is when Chris spoke about tax revenue and total expenditure, and looking at the expenditures on the government level. So I've read some few articles when I see in some few governments in Africa who there's so much high expenditures, and some of them uses franchises and then subcontractors and to get those high expenditures. So my question is maybe, or suggestion, but just to say, is there any model that of expenditures of government? Like South African government. My second question is about the bailing out of the ESCOM. What makes ESCOM being bailed out time to time? So that's my little questions I have. Thanks.
Thanks, Michael. Azar?
Mr. Governor, firstly, congratulations to the Reserve Bank and to Chris for an outstanding presentation. Secondly, has the Reserve Bank actually done research into the following hypothesis? As the trade war intensifies, so the rand weakens against the dollar. To what extent does that help to compensate for the negative effects on the economy of the trade war?
Yeah.
Tsabiso Poswa from the Competition Commission. Since the bank has highlighted trade as a risk, I just wanted to find out that given the much spoken about African free continental trade area, and there's a lot of theory about how free trade areas could possibly results in trade creation and or trade diversion. I just wanted to find out whether, in the worst case scenario of trade diversion, what has the bank assessed such theory, a trade diversion, what effects that would have for the South African economy at large? Thank you.
What do you mean trade diversion?
It's a trade being diverted away from South Africa from the African continent, since there's going to be an African free continental trade area, and trade being diverted away by non-members of the free trade area to outside of the African continents. For instance, the USA or China, trade that we receive from them being diverted away from the African continent and maybe to somewhere else, a different location.
Dennis, welcome.
Thank you, Governor, for the invitation. My name is Dennis George. Governor, in June this year, President Ramaphosa confirmed the mandate of the Reserve Bank. Shortly after his statement, the alliance partners of the government issued another statement to say they want to see that the mandate of the Reserve Bank must be amended to include employment and economic growth, a kind of a similar approach that the US have of a dual mandate. And during 2010, the previous Minister of Finance, Pravin Gordhan, issued a letter to the Reserve Bank to say that the bank, should be more mindful of the contribution that it could make directly or indirectly to support inclusive economic growth and employment creation. Will the bank start to engage in a process like that with the public about that mandate, or is the government, the Reserve Bank, going to stick with the position of the President?
Good. Ladies and gentlemen, it's your turn. Not sure who wants to take what, but the easiest one is Yanni's question about the view on the government's economic recovery plan. That's the easiest one. If government needed to hear about it, rather they would hear it directly from us rather than through a public forum. So we have not expressed a view. But Kuben, can you deal with this? I'm not sure that I understood this thing of the model of expenditure and the ESCOM one you can deal with too. It's also very easy for you. And then Chris, can you deal with your with Azar's question, because it's very much a research thing, and whilst you are at it, you can deal with the free trade area and the diversion. I hope I understood that. And Fundi, since you are such a good teacher, will you deal with the mandate and the bank and the growth and well, Dennis said that the US Fed has got a dual mandate, but I know them to have a triple mandate. If you could deal with that too. Thank you very much, ladies and gentlemen. Who's starting first?
They want time to make up answers to the questions, so I'll go first. No, so on the trade stuff, yeah, I mean, look, these are all interesting questions. I mean, I can't answer any of them really, except to make a few observations. I mean, one, as your question, I mean, the obvious point there is that depreciation helps you price back into markets. What we know less about is the extent to which these are volume declines associated with these kind of trade problems. You know, so as long as volume demand keeps up, the depreciation will certainly help. But, you know, it won't help when the volumes collapse. So the obvious answer to that. And a similar kind of thing on the African Free Trade Agreement. You know, I mean, I think the big thing is is understanding the extent to which African economies are part of these global value chains affected by the trade wars. I don't know the extent to it, but my rough guess is that they're relatively removed from global value chains. And so if you think about South Africa's own exports, we export now about 30% of manufacturers into Africa, but most of that is stuff like food manufacturing. And it really has nothing to do with global value chains. There's nothing to do with trade between the U.S. and China. Our trade to advanced economies is much more on commodities and things like cars. And I think those are a little bit different. I mean, cars, I can imagine becoming a victim of global trade wars, but then it wouldn't work through Africa. It would just work South Africa to advanced economy markets. So there are particular aspects of trade, like automobiles, where there could be effects, but probably not too many other ones. And I guess in a funny way, that's, it's a sort of perverse benefit of South Africa not being more integrated with the rest of the world's trading system, that when that trading system takes a shock, then we get hit less by it. But, by the same token, we really don't want global growth to decline, because that indirectly will impact on these volumes. So it's not a very satisfactory answer, but I think if you unpack some of those relationships, you might get some clearer answers about how South Africa is affected by ructions in trade. Thanks.
Okay, sure. Thanks, Chair. Let me start off by just adding a little bit to Chris's answer on the trade weakness. So, Dr. Jamin, I think you're correct. The trade weakness globally, you got the rand falling, that mitigates part of the impact. I think that's correct. There are, however, two channels by which a falling rand impacts on the economy. So it does, in some ways, mitigate some of the impact of a fall in trade. But a weaker rand also tightens financial conditions for companies and corporates. In general, it raises the borrowing costs and it raises the cost of capital and capital equipment. So you get these two effects, a contractionary effect from the falling rand and the expansionary effect from being able to price your trade better. Under normal circumstances, those things more or less offset each other. But in the context of a trade war, and the trade channel is blocked, you might get a situation where the weaker rand is actually constraining firms and firms' expansion and firms by raising firms' cost of borrowing more than you would benefit from the trade channel. So on average, it's contractionary. I don't know, but I think those are the two broad channels through which you'll think this thing through. Chair, if I understood the question on sort of what's an ideal level for government's expenditure, I don't think that there's a precise answer to that question. Is there a model for government expenditure? I don't think there's a right level. I think we've got to compare ourselves to similar countries at a similar stage of development and competitor countries. If you take the countries that we do compare ourselves to and you exclude sort of oil revenues from countries like Brazil and Mexico, we have a relatively high tax to GDP ratio. Right? And we have a relatively high share of government spending when you compare ourselves with most upper middle income countries, adjusting for oil importers or oil exporters. And so we're not on the low side of the tax side in general. We're not on the low side of public expenditure. Now, there are other factors that feed into that. We're a highly unequal society. And so there's a significant social wage that is contributed or subsidized in some ways from the tax base, and you've got to understand that. In some ways, that's the difference between South Africa holding things together and South Africa genuinely collapsing. And so there's some justification for that. But I think the point that's being made is that there doesn't appear to be significant additional room for tax increases. because that may further undermine household consumption and wealth creation, and that may further undermine domestic confidence. And so you've got to maintain a balance in that regard. On why Eskom gets repeated bailouts, I wish I knew the answer to that. I don't know the precise answer to that. I think it's a question you better ask those who are giving the bailouts. But let me make 2 or 3 points about the structure of state-owned enterprises in South Africa. In the National Development Plan, there's a chapter on state-owned enterprises and on governance, and it points out that weak governance in state-owned enterprises is a significant reason for the underperformance. In many cases, CEOs are appointed through political interference in boards. Board members are appointed through significant, in some ways confused and convoluted processes. There's no clear lines of accountability between the shareholder, the board, the CEO. There aren't sufficient performance metrics, insufficient performance management. And this was written in 2011, 2012, a fairly detailed account of the structural weaknesses in state-owned enterprises. And I think that those structural weaknesses in the main explain the poor financial performance of state-owned enterprises. And I think that there are state-owned enterprises elsewhere in the world, Singapore comes to mind, some enterprises in China, that do have sound governance, that do have proper lines of accountability, and it turns out that their financial performance is better and they require less bailouts from government. Thanks.
Right, so I've been left with the more difficult question. Thank you very much. So, the way that I tend to think about central bank mandates is to try and divide up the question in 3 ways. I try to think about what is it that central banks can do. I try to think about what instruments they have at their disposal. And then I also try to think about what is the response to that action that central banks then take. So central banks, we argue that monetary policy tends to influence growth around the business cycle. So we tend to moderate growth. So if this is what happens to growth, we try to bring it up. And we do this through this instrument that we have. So one of the primary instruments that we have is the interest rate. So we have an impact in the cost of borrowing in the economy. So arguably, one could assume that if you have relatively low interest rates, then you are more likely to invest more. If you have relatively lower interest rate, then you could have some consumption. And that from a broad planning point of view, you could say that businesses are able to hire more people, and there is causality in that direction. But what we have seen when one studies the South African economy and one looks at a number of surveys that are undertaken, and the issues that businesses raise, they will say, some of them will raise the issue of cost of capital or access to finance, but that seems to be outweighed by a number of other factors which are broadly structural in nature. So what are the other things that are preventing businesses from investing? So let me turn to then more directly to your question about the fact that there has been this debate around the mandate of the SARB that is out there. So when we read what the Constitution says the mandate of the SARB is, we think that already takes growth into account, because price stability is not the end. Balanced and sustainable growth is the end, and that is what is defined in the Constitution. And price stability is a very important element of having balanced and sustainable growth. It's important to enable planning. It's important to also have a lower cost of living, a lower cost of doing business, which we think is a core component and quite essential for growth. We do spend a lot of time in the MPC discussing growth, discussing employment outcomes. I think the key issue that distinguishes South Africa from an economy like the US is this transmission mechanism. What happens from the time in which the SARB takes a decision to reduce interest rates to the end result? Is there a natural transmission that happens, that when the SARB lowers interest rates, you see an investment response, you see a response that translates to employment at the end? We have not seen that. And hence, we spent a lot of time talking about the importance of having structural reforms that improve the growth potential of the economy, that lower the cost of living. That will, over time, improve the transmission mechanism from what we do as the central bank to then feed through to the economy as a whole. So that's my long answer. I hope it helps. I forgot the letter. Would you like to talk about the letter, sir?
Can you talk about the letter? Because I think that there is a paragraph or two that come directly from you in that letter.
That come from me in that letter. So the letter that we received from the Minister of Finance, if one were to compare that letter, the 2010 letter that we often refer to other letters shared between the Reserve Bank and the Treasury, there's broad consistency in that letter that is related to the mandate as it is. Because what that letter says is, Reserve Bank, don't forget to take growth into account. It's important that you take growth into account in your decision making, which we believe we continue to do. The additional area of work that was included in that letter was the importance of price stability. And that has since then been taken into account in the legislation, in the financial sector regulation, financial stability. So that financial stability mandate, which is the new mandate of the Reserve Bank, is now fully incorporated into what we do. And in essence, the 2010 letter is reflected in the work that we do as the bank. I don't know if the Governor would like to add.
No. There's nothing to add to that letter. I think that the letter was accepted by the bank, and the only thing that I thought I want to, because this example of the US which was used, actually the mandate of the Fed reads something like, it must strive for low inflation, maximum employment, and low long-term interest rates. That is how it reads. And we get stuck in this thing of the Fed has got a dual mandate. Truth of the matter is that there is no central bank that does monetary policy and will not take cognizance of what employment means and what growth means, because they feed through into the inflation process. If you have got negative growth and rising unemployment, it could dampen on inflation, in which case you take a different posture. It has not changed. It has not changed your. And by the way, at the moment the US is growing at full employment. The problem they are having is they are trying to create inflation, and they are not succeeding in creating inflation. They have got low inflation. And guess what? They also have low long-term interest rates. Now, South Africans get this one clear. If you want low interest rates, you must get inflation lower. Higher inflation begets higher interest rates. There are people here much older than me who lived through the 80s, and they know what it meant when inflation was 18%. When inflation was 18%, interest rates were not 6.5. Get that thing clear. And more importantly is that actually this economy was not growing. So the notion that you can somehow deceive economic agent by shocking them and creating inflation and then hope that you would surprise and then create growth and then create employment, it's not grounded in literature, and it's not even grounded by experience. And I've heard people who say that, oh, we have had jobless growth, and maybe that's true, but I know that this country creates jobs when it is growing. At the moment, we are not creating jobs, and the reason we are not creating jobs is because we are not growing. I am yet to find one country in the world, one, that is not growing, that has got high inflation and has got rising employment. I can't find one. But somehow we seem to think that in South Africa, we are so special. We are this God's chosen country that we can somehow have high inflation, and by having high inflation, have high growth, and by having high growth, we will have high employment, and by having that, somehow we will also have low interest rates. That's not how the world works. That's not how the world works. That's not how economies function. Anyway, shall we take the last round of questions? No, there was one hand there. And you are also interested. That's two. And there was another one at the back there. I don't see it. That's three. Those are the three. And then there's another two. Can I see them? Can all the hands up? If you still want to ask questions, can I see all those hands up? So it's you, ma'am. It's 1, 2, 3, that ma'am there. And then 4. That's 4. That is it. You are the last one. Thank you. Any other? You can continue the conversations during the interaction. Shall we start with you, ma'am, at the back?
Ina Hewitt from ABSA. Governor, a question around, I don't think anyone wants inflation that is driven by low interest rates, but if you look at the way you've broken down your inflation numbers, you stripped out a component called government CPI, which was around 6%, and then we also know we have a lot of imported inflation from a depreciation of the currency. So the portion that remains is, I guess, your consumption and investment driven part that could actually respond to lower interest rates. And since these other two factors are so high, you'd presume that that one is actually quite low, the inflation in that bracket. Do you think that lower interest rates would have any impact whatsoever on the government one or on the imported inflation? And if it doesn't, do you strip that out when you look at things in your model and use that to determine or to influence your decisions?
Okay. Chris, you are going to answer that one. I can't find any evidence of imported inflation at the moment in South Africa, but Chris will answer that one.
Iman Anderson, Vaughan Sterling. My question is, does the Prudential Authority or the Financial Stability Department have a role to play in the Old Mutual fiasco?
That was not the subject of the MPF. Yes, ma'am.
Good evening, Governor. Rafilwe Maleka.
You swallowed your first name?
Rafilwe.
Rafilwe.
Have you performed an analysis and factored into your planning the potential short-term, medium-term, and long-term impact of the perceived decrease in confidence in the CASA profession on the economy versus a perceived turnaround if that perception, if whistleblowing is encouraged and confidence is regained in that profession?
Okay, thank you very much. Are you a CA? You don't have to respond. The back.
Thank you, Governor. Mapale Maponya from Rongwa Consulting. Look, Governor, my issue or my concern is that I feel that, it's not business as usual with things that are happening right now, economic-wise, and I fail to gather confidence when I come to this MPF to say that how does the future hold in terms of us as when we run small business, and yesterday, interesting enough, I was reading an article on the business report when. The president had the meeting with the Association of Banking Association, the leadership of the Banking Association and other leaders, and they really mentioned, issues that are typical in terms of the challenges leading to the government, issues leading to visa regulations, issues related to ESCOM, and I feel that is an excuse. We need to really look into a way in terms of reviving the economy. And when I look at this, an analogy that comes to my mind, it's when from a storytelling perspective, when I think of, the issue of Titanic, where our economy being, heading the iceberg, and we, people, scrambling to save their lives, but the leadership, the Reserve Bank, are those guys who are playing violin while everybody's going up and down and trying to survive. And we need leadership in here. So my question here is essentially is that what are the tools that we can use so that we can revive this economy, so we can transform this economy? I'm thinking about, can't you really look into quantitative easing? Is it that bad? Is it really that bad for the sake of growth and prosperity for the future? And other developed advanced economies are using that as a tool. Are we that special, like you said? Are we really that special not to explore that? Okay, we'll talk after this.
I thought we are talking. Okay, Chris, inflation. Huh? There was the last one here, yes.
Good evening. I'm Fungo from Crested. My question is about fiscal deficit. What I wanted to know that, if, let's say, the Treasury continue to be in deficit, is there a situation whereby the deficit will be kept by monetary expansion by the central bank? Thank you.
Okay, thank you. It's related. It sounds close to the previous one. Naidu, I don't think we should deal with the old mutual question. Which one do you want to take? Anyone?
It's the CA one.
Yeah, you want to take the CA one. Okay.
And any other.
Fundi, you want to deal with the easing of quantities? You are happy to come in last, okay. Okay. Naidu, but Chris had more time to prepare for the question that was asked about, by Ina, about.
Right. The short answer is that yes, we have a core inflation measure and we look at it, but it's not the measure that we target. We target headline inflation. I'll come back to that just now. When you look at core, there's services and there's goods. So the driver of the disinflation that we've seen is primarily via the exchange rate into those goods prices. I showed you how tight that correlation is. And then you get core pulled up by services. Now, core has come down quite a lot, and that's important. And you think a bit about, well, what would interest rates do to growth? So if we were to target core and core is at 4% and we cut interest rates, what would it do? That's a tougher question. And again, I tried to deal with it a little bit in the presentation. You want to think about what's a demand factor and how much of the demand factor is pulling down that growth rate and how much of the supply factor is pulling down the growth rate. On balance, pulling these things apart is pretty difficult. In Q1, for the Q1 decline in growth, our assessment was that 50% of that was a decline in potential growth. There were various things going on. A big driver of it was the Eskom electricity shortage. There was a big set of strikes at the time. So all of those things are basically supply-driven hits to growth, and an interest rate cut, in our estimation, in that instance, isn't going to do a lot to reverse that. There are some other longer-term drivers of demand which are kind of worrying too. One has been something that we flagged for many years. We don't talk about it as much now, but it's still there, and that's just the overall high level of household debt. So credit demand by households is not very robust. So one of the channels that you would imagine an impact on growth would come through is if you cut interest rates and households start to demand a lot more credit. There would be a positive effect, but we don't really think it's that large. For businesses, there are a whole range of other kinds of constraints, and back to the Q1 story, a big chunk of that is energy. If you cannot get your electricity supply, then corporates are not going to invest, and I think we've heard a lot of stories about why that's a problem. I just refer you to two articles in the paper recently that struck me as quite interesting. There was one just the other day about DBSA, and there was one about 2 weeks ago about the BRICS Bank. BRICS Bank was giving a 7 billion rand loan to Sanral. DBSA has a whole bunch of loans that they're doing for public infrastructure, but both articles made the point that the officials in those institutions say, credit is not the problem. There is plenty of credit in this economy. It's just that demand for it's very weak. So, is it an interest-sensitive sort of thing? Personally, I'd be a bit skeptical of that, and I think in our MPC discussions, that sort of, we ask ourselves a lot of hard questions about, well, how responsive would that be, would the economy be to an interest rate cut? Our model has a stock answer, and it's a substantial answer, but we haven't seen it coming out in real life. And so, I think that leads to a lot of skepticism about the utility of interest rate cuts in the environment we're in. Now, just back on the headline versus core issue, we don't target core. The inflation targeting framework explicitly said we want to address the inflation which responds or correlates with people's lived experience of inflation. A lot of our inflation is driven by things like food prices, which is also not terribly interest sensitive. But it has a big impact on households' standard of living and their well-being. So, you have to be really careful about when you choose the inflation target of stripping out everything you don't like, and then what are you left with? You're left with a target that means nothing to many people. That matters quite a lot in another sense because there are indirect effects from inflation. So if we cut interest rates, the rand depreciates for, let's say it depreciates by a lot more than we expect it to, that passes through into the CPI. And that becomes growth negative. So if there isn't just a Phillips curve at play here, there are a lot of other things going on which you need to think about. And that I think matter quite a lot. Now, just to help Fundi out a little bit here, I think this point about DBSA and BRICS Bank gets to this thing about QE. Would flooding the economy with money, watching inflation rise and the rand depreciate, generate a lot more confidence or choose the right kinds of investment products? It's quite unlikely. QE was put in place to deal with a financial sector that was short of liquidity. So these are balance sheets with across the US and European economies that have gigantic financial holes in them. And the only way to fill those holes was to provide tons of liquidity. I don't think we're in anything like that kind of position, and South Africa hasn't since the financial crisis. So that's my addition to the QE question. I don't think it applies to us.
Well, now that Chris has started, he hasn't given me a choice. Okay, so I think that there are costs and benefits to every decision that you have to make as a policymaker. And some decisions and some choices that you make might be giving you a benefit right now but cost you in the future, and some of them are costly right now and they give you a benefit in the future. And what we say as we're playing the violin in this institution is that we think there are long-term benefits to having low inflation. But we're not saying that it's low inflation at all costs for us. And we understand that there are periods in which one must tolerate having inflation that might not be around 4.5%. And that is the true test of whether the SARB is playing the violin or paying attention to what's going on in the economy. And this is a debate that we've been having a lot in the MPC about what is it that we can also do. Because if we allow ourselves to relax and we say, well, it's okay for inflation to be out of hand, we also have to think about what that means over a longer term period. What we cannot do, however, is to go into areas that are not defined in our mandate, to go into areas where we are doing things that we are unable to do as a central bank. So very difficult for us to cross into that area. So Chris has already touched on the issue of quantitative easing and why it's not an option for us. So we are still not in a deflation environment where we have to then use our instruments in the opposite direction to try and spur on the economy. We are still in the realm of positive interest rates, and we're still trying to control inflation, because unlike the economies that are putting QE in place, we still have inflation challenges to manage. And the core issue that we are focusing on is at least having inflation expectations that are anchored. And we believe that if we have an economy where we're all thinking about inflation at the same low level, then you start to have planning that is based on those low levels of inflation. So I think that as we are having the conversation, we are very open to having a conversation with government. We have highlighted which areas where we think structural reform will have an impact on. And that does not mean that we are relaxing as a central bank. I think that maybe when Kuben talks about his area, so there are other parts of the bank that do other work where we are looking more broadly at what it is that we can do. So when one thinks about the payment system, for example, which is the backbone of how we make all payments and facilitate financial transactions in this economy, there's a broad area of work where we're thinking about, well, how do we get more non-banks to be participating in the payment system? So that is a different contribution that the central bank makes to providing a lower transaction costs for users and customers in the economies overall. We are also doing work to look at how we lower the cost of remittances. This is why you're now getting entities like ShopRite and Pick n Pay and the SPAs being able to facilitate payments and movements of cash in the economy. So there are other ways through which the central bank, I would say, contributes to the broader discourse of what is going on in the economy. But the interest rate is sort of one instrument. It's geared to allow us to anchor expectations of inflation. And we think that that's a core institutional framework that one should not give up in panic, because over the long term there would be costs to that.
Thank you, Chair. You know, I mentioned state-owned enterprises earlier, but we've also had a series of corporate scandals in the private sector. Steinhoff, Tongaat, several of them. And I think there's absolutely no doubt that what all of these things have in common is poor governance, right? And as part of a governance framework, you need good auditors, internal audit, external audit. You need credible, independent institutions that provide checks and balances to the public and to investors. And so it's absolutely true that the knock of credibility of the auditing industry in South Africa will negatively impact the economy, and it will negatively impact investor perceptions in South Africa. I think it's a fixable problem. I think it's not so long ago that South Africa was ranked in the top 3 in the quality of auditing and accounting, and I think that it is a fixable problem for us to get back up there. I've got no doubt that we will, but it's hard work. In fact, just yesterday I was looking at the numbers. In the last 10 years, the number of registered auditors in South Africa has been stable at about 4,000, right? And their average age was, I think, around 46. I then looked at the numbers for SAICA, so the Institute of Chartered Accountants, and the number of registered chartered accountants in South Africa has been rising steadily. And the average age is actually 36. Right? So within the same profession, with the same similar type of qualification, you've got both a positive story and a negative story. And I think there's a genuine need to fix the reputation of the auditing industry to ensure quality audits. But I do not think that South Africa is facing a long-term constraint in this area. I think it's a fixable problem.
Very much. Panelists, you have done very well. You've made my job very easy, and I am sure you must come and do some announcements. We will offer some quantitative easing outside as you leave. And yes, this is the standard. We do offer quantitative easing. Let's see how well you use it.
Just a quick housekeeping issue. Mr. Selekwe, if I'm pronouncing it correctly, can you please collect your wallet on your way out? It will probably be at the registration desk. Thank you, ladies and gentlemen, for your attendance today.
I wanted to check if Mr. Minella wanted to add anything. I didn't see you come through at the beginning, but you are welcome. As you can see, some things have not changed.
The governor was calling it quantitative easing. I'm going to call it sustenance. So please will you join the governor and the panelists for a light supper and a networking session in the dining room area of the bank. There are staff stationed outside who will direct you to the venue. I could smell and hear the rain, so everyone drive home safely. Thank you very much.